You're looking to value your business, there's 4 key elements that you need to focus on. This video is going to take you through each of those in detail. At the end, I'm going to work through an example so that you can use that in valuing your own business. It's important to note that valuation is not just an issue for someone wanting to sell. You're making an investment in business. You're taking a risk. You want to know the return, and you want to know that you're nurturing and building value over time. Just like a residential property or a commercial property, you look at that from 2 perspectives. Look at it from the yield, the return that it has, but you also look at it from the capital growth. Well, it's the same in business. Firstly, external market, competitive trends and issues. You need to take a good, long, hard look at what's going on in your sector. Who are the movers and shakers? How does it impact your business? Is regulation and compliance a factor in your business? And is that having an impact on the returns of your sector, but also what's required to run a successful and profitable business? Are there other disruptors from a technology perspective or a business model perspective that are impacting the way you go about your business? Remember, for instance, the age-old example of video stores. Once a dime a dozen, and then suddenly they're gone because they're replaced by new technologies and new trends in how people consume media. So that's just one example of how an external market factor can really impact your business. Ultimately, what you're trying to do in looking at the forward market and trends of your sector is figure out whether it's positive, neutral, or negative to the prospects of your business going forward. The second one is business health factors. So here, we're really like a GP giving your business a health check. So as a business owner, pretend you're the GP. And when I say, do a diagnostic check, what do you look at? There's some key things. Looking at the people in your business, your team, the strength of your team, your attention, their skills, their capabilities, their culture. How well does that team gel in your business model to deliver what you need? Another factor in the diagnostic would be systems and processes and technology. How well does the business use technology and systems and processes to drive a consistent outcome in terms of the product and service it delivers? Are there breaks in the system currently that could be fixed by more technology? Do the systems and processes and reporting regularly provide updates and benchmarks and monitoring on the performance of the business? You will know, I'm sure, as a business owner, how you would rate that from a business health perspective. Your supplier relationships, how strong are they? Do you have more than one? Are you exposed to one particular supplier? Is that a concentration risk if they were to go out of business? Another key one, of course, for business health is your client or customer portfolio. What's the relationship like with your customers? What's the portfolio of clients you have? Is it concentrated in any particular customers, geography, or sector? Or is it evenly spread and therefore a diversified portfolio with little concentration risk? We actually have a free health check survey on our website. It's confidential. And so if you're interested, check out the link below. Let's go on to number 3, and that is future maintainable earnings. Now, here we get to the financial element. Future maintainable earnings are a theoretical measure of the performance of the business in terms of earnings in the very next year. If you're sitting here today, it's looking at the next 12 months and saying to yourself, what do I think the earnings are of this business on a regular basis and sustainable basis, knowing the forward prospects of the business, but also knowing what's been delivered over the last 1, 2, 3, maybe 4 years. Now, the proxy measure is a measure called EBITDA, earnings before interest, tax, and depreciation amortization. And so you can calculate that looking at your profit and loss statement. What we do in coming up with future maintainable earnings is also take out or add back any items that are a bit abnormal. So, for instance, you may have had a legal claim in your business. Let's say it was $50,000 of legal costs. What we look at is that a one-off claim? And if it is a one-off claim, then that expense would be added back to profit because, it's something that doesn't happen regularly. Similarly, If you're an owner working in the business, you may be taking dividends rather than a regular wage. But to calculate future maintainable earnings, we need a wage in the business that is appropriate for you as a working owner. Because at the end of the day, the future maintainable earnings represent the earnings of the business fully operational, fully costed with all the income associated with the business and all the expenses associated with the business. So you can have a go at calculating future maintainable earnings, and sometimes what we do is we look at those earnings over the last 3 years and then potentially weight the percentage for each of those years that is relevant when looking forward to the next year and saying, well, what's that next year going to be like? Are the prospects incrementally positive versus the last year, about the same, or negative? And therefore, looking at the last 3 years, I'll weight a percentage to each to appropriate what the next year might be like. Future maintainable earnings is a key factor in determining business value. The last and fourth element to look at in business value is market comparables. So market comparables are, what are investors, other businesses acquiring like and similar businesses for? And here's where you need to keep your ear to the ground to see what's happening in your marketplace and talk to advisors and others about what might be being paid for businesses. There's various ways of valuing a business, but with market comparables, often the determinant is a multiple of earnings. So for instance, if you're a pharmacy, your business might be making a multiple of 5, 6, 7 times earnings. Now remember, we talked about future maintainable earnings. Let's say future maintainable earnings is $500,000. You've calculated using the components that we spoke about before. If like and similar businesses in your sector are making around about 5 to 7 times earnings, then $500,000 times 5,000 is $2.5 million. $500,000 in future maintainable earnings times 7 times is $3.5 million. So we've calculated a range in terms of your business's value, 2.5 million to 3.5 million in enterprise value. I say enterprise value because there's a difference between enterprise value and equity value. Now, we'll go into that in more detail, perhaps in another video if you're interested. But the enterprise value is effectively the going concern value of the business, and it covers the assets that you're using to generate that return, your working capital, and any goodwill associated with the business. So, we've covered now the 4 key elements associated with valuing your business. So let's use an example to help you work through those 4 elements and make them more real to understand the factors that might impact in coming up with a valuation. So we've got an engineering business. They've been around for 30 years. One owner. The owner's heavily involved in the business and works in the business. There's about 25 staff, 10 million turnover. Turnover's been fairly static over the last 3 years, and profit at the bottom line has ranged from $1 million to $500,000 over that period. So we talk about the external market first. In its particular market, there's a number of recent competitors that have set up shop. They're new and they're very aggressive in terms of going for projects, bidding closely on margin. There's also a deficit in terms of good staff available for engineering. There are also other safety regulations that are increasing in the industrial sector, which are impacting compliance and training and costs associated with the operations. Health factors are an interesting one for the engineering business. They've had for many years 3 very, very solid clients. Strong repeat business. But those clients make up 60% of the $10 million turnover, typically. So there's a health factor issue there, along with another one, and that is to do with the owner. The owner has many of the client relationships and does a lot of business development. The owner's well known in the local region and community, has a strong reputation, but there's a lot of owner risk associated with that one individual that therefore is a risk to earnings if there was something to happen to that owner that might impact the business. Moving on to future maintainable earnings, this business has had earnings that have varied from $1 million to $500,000 over 3 years. They've been a bit up and down over the period, largely as a result of projects that have come in and out, and the earnings have showed that volatility at the bottom line. The forward earnings, looking at the pipeline of jobs and work, indicate an earnings for the most recent financial year of about $1 million. So it's fair to say that future maintainable earnings are going to be in that region. Maybe from 800,000 to about 1 million, but let's say 1 million for the sake of the example. Now, market multiples. In this market, we're seeing multiples of earnings on valuations of like and similar businesses sold between 3 and 5 times future maintainable earnings. So as a result, you'll see a business worth $3 million to $5 million. Now, that's a big range. How do I calibrate where this business is in that range? Well, remember the diagnostic? We looked at the health factors, and there were 2 key health factors that were, somewhat positive in terms of business reputation and client relationships, but somewhat negative in terms of business transfer and business risk. They were client concentration and owner risk. And so those things weigh on the attractiveness of the business for transfer in a sale process. And therefore, they will impact the multiple of earnings. And the likelihood is that business will trade for more like 3 to 4 times the future maintainable earnings than 5 times because of those risks. So it's important to take into account all 4 elements when finalising your view about what that value might be. So we've covered the 4 elements that are critical in valuing a business. And as a result, you should be better armed to figure out what your business might be worth. And remember, valuation is not just important if you're thinking of selling your business. It's also really important as a management tool to improve the performance and return of your business. And we've actually got a video on using valuation as a management tool. So have a look below and tell us what you think of that. It may be useful in terms of driving better performance within your business. Furthermore, on this video, I'd love to hear what you think. Please drop us a comment and drop us some views about what else you'd like to hear on this channel. I'd love to hear from you.